Welcome back. This is Chart Overload. I'm Ryan Mumy, CEO of Sollinda Capital Management. With me is my partner, our Chief Investment Officer, co-founder, Justin Greenhill. In this Chart Overload, we walk through some charts that we don't feel like maybe the mainstream media is talking about enough, and we pontificate on them, what we think it means or could mean. So anyways, let's start with the big picture. Justin, first one, we've got the old PCE core measure of inflation ramping a little bit back higher here.
Moved up. Notably, this is net of energy. So this is basically everything inflationary that's not directly going to be driven by oil. So as you can see, way below 2022 highs, but nonetheless starting to pick up. So I think it's really two questions. How long does this last? But more importantly, does it actually start to trend?
I mean, we could say that inflation is not isolated to just oil, right? I mean, it's spreading out throughout the economy. And despite this next chart, this shows consumer spending actually accelerating and, American consumer not being tapped out yet, if you will, and spending despite higher prices.
A lot of this potentially has to do with, what we've talked about as the wealth effect. So people, as their stock portfolio moves higher, they feel more confident to spend. And we don't have this pictured here, but consumer sentiment has continued to drop straight down lower for really 3 years now. So collectively, there's negative expectations from the consumer, but yet the consumer continues to show up. So the thinking is that it's a smaller percentage of the population who has financial wealth and really buys bigger ticket items, more luxury items.
Next chart looks at the Fed funds rate, where the Federal Reserve sets it versus the projections, and close but off.
Close but off. It's like the title of your blog post on the Fed, close but off.
Yeah, maybe.
Yeah, so Fed fund expectations are just going to be a collection of the derivative market's current pricing. So this is not to say that there were people sitting around only trying to predict it. These could be banks or financial institutions hedging, which create this as well. But nonetheless, you do tend to see here for quite some period of time, the market overestimated the Fed's likelihood to hike interest rates only up until the point when the Fed did hike a lot in 2022, of which the market then consistently underestimated it. So we're in a situation right now where it's really just not that the prediction is anything to note, but it's changed a lot. So the market earlier this year was, expecting multiple rate cuts this year, and now it's expecting at least one hike. So it's really that rate of change that has been absorbed by all markets.
Next chart, we thought about putting this in the domestic stock equities portion, but this just covers kind of everything. And this is the growth of leveraged ETFs by investors, how much money is in these. And just as a reminder, is these are investments that if you want to track, for instance, the S&P 500, you can track the S&P 500 with an ETF that has 2 and 3 times embedded leverage to give you 2 and 3 times the move of the just regular S&P 500. And the amount of money invested in these has, it's been going up for the last several years, but it's skyrocketed this year.
Most notably, the green line there, second to the top, is the long only category. So those are things like the levered semiconductor ETF, of which we'll get to in the next section, or like you said, levered NASDAQ 100 would be another big one, tech sector, and even down to levered individual names. So
Yeah.
3 times Tesla, 3 times Nvidia, et cetera. And, people are getting long on leverage, right?
Yeah.
You got to get in.
Oof. Moving on to the next one. This looks at users' use of different models of AI. And a year ago, it was heavily dominated by the biggest United States AI models, language models, and the Chinese versions have caught up tremendously.
Yeah, to say the least. And there's supposedly several reasons for that. One could be the fact that the news flow has had the government telling Anthropic, when to close certain models or release other models, and there's that dynamic. But then there's also, moving to the next chart, the fact that Chinese output of electricity has gone up substantially in the last several years, which just makes electricity less of a constraint to, Chinese models relative to the big concentrated US models, Anthropic, ChatGPT, Gemini, etc.
Well, there hasn't really been a need for the US to really spike their energy output until recently. And it's a long cycle, right? It's a long process to put up a new power plant. And, we'll see with the advance in technology, we'll see what happens with more mobile power sources. But you look at the projections forward, they've caught us and they're going to exceed the United States if the forward projections hold true. Let's move on to our next section, looking at domestic equities. As Justin referenced, semiconductors have been hot and they just are closing today their best quarter ever.
It's been pretty remarkable. This statistic here, though, does in fact represent that we entered the month of June, following what was, in the case of semis, a pretty decent sell off coming into the first part of the year, into the end of the first quarter, into the second quarter. But that's a huge move. So not only has semiconductor stocks gone up a lot, it's done it without NVIDIA being the leader, which just goes to show that being already so big, how much various other semiconductor stocks went up to justify a collective index return being this large.
And the next chart, because they've went up so much, they make up 18% of the entire S&P 500.
Which to think in 2022 they made up 5% of the S&P
Yeah,
500.
right.
So that's one extremely volatile cyclical sector, that's making up close to a fifth of the index. Which, on to the next chart.
Yeah. This is a combination of several charts, right? This is the leveraged, 3 times leveraged semiconductor index ETF. And this shows its massive spike in assets that are holding those shares.
Yeah, so this is the amount of money that has gone into just one triple time long semiconductor ETF. So note the rise over many years, which one could say that's as these levered ETFs have become more popular and semiconductors has been a popular space. But notice the spike there to the far right. That's
It's humongous. And I mean, why we kind of talk tongue in cheek about this is semiconductors are one of the most cyclical sectors ever, or they have been historically in markets. You look back in the end of 24 into 25, this triple levered semiconductor ETF, its market cap got cut in half, right? So that implies a 50% drop in the amount of money in this, right? You can guess what happened to semiconductors around that time. So, again, to see that sharp rise in 2026, elevator up stuff, that's, is there a waterfall moment on the other side, or is this kind of the new normal with computing power and with the economy? Who knows? Next chart looks at just the Mag 7, their trading volume going back to the beginning of 2025. And as we see here, it's pretty clear that demand for those shares has waned for the most part over most of this period, definitely the last year.
And it's most likely, or at least in part, gone to semiconductor stocks, right?
Yeah.
Tying
Right.
everywhere else. So, unlike semiconductors, which have recently benefited from the narrative of sustained high prices for memory chips, the Mag 7 have recently underperformed. And a lot of the narrative is that AI will disrupt companies like Microsoft, or that Meta, Oracle, Amazon, et cetera, are perhaps overpaying and will have to continue to overpay for everything that goes into their AI capex. So there has certainly been a historic underperformance of mega cap non-semiconductor stocks to mega cap semiconductor stocks, and this just shows that in the two volumes.
Next chart looks at the forward price to earnings ratio of the Mag 7. And again, as we see here, they're almost one standard deviation below the median. And, one would say strictly from a price to earnings standpoint, they, from a historical standpoint, are moving towards the cheaper version of themselves.
And that really has all to do with the fact that the market is just more uncertain around future earnings, whether it be Microsoft for software or cloud services, or, the ability to recoup AI investment and so on. It's been pretty interesting that we've not really gotten any correction in the market because of the dispersion between some things really outperforming and some things not, that the market's still close to all-time highs, yet the multiple of the market has come down that much. It really sets up to earnings would have to be really terrible coming up for the market to, want to get any cheaper on that basis.
Next chart looks at the really big JP Morgan hedged equity. JP Morgan launched this fund a long time ago. Now they have multiple versions of it. And its construction, it's a really big player in the options market. And this kind of overlays the S&P 500 versus that big fund's key strike points on some of its big option holdings.
Which this doesn't necessarily mean a lot, but what it does kind of mean is that if the market starts to move during this, into options expiration period, you're tend to going to see the market at least pause, if not stop, at some of those key levels along the way. But thus far, there's not really been too much to do with that, other than the fact that the market ran down, kind of touched it a couple times, and it will soon pass, right? Options expiration this week had a monthly and now a quarterly.
The next chart looks at the upcoming earnings season that's about to be upon us, along with the buyback blackout periods when companies can't buy back their shares. And we're entering the ramp up in that where companies can't do that.
Yeah. And it isn't really this quarter, but in the subsequent quarters, we're starting to come into the dynamic that we've discussed where the big mega caps are going to be buying back less share. And in some case, they're going to be issuing shares, and there's more mega cap shares in the market, first with SpaceX and then likely with Anthropic and ChatGPT. So this might become less useful over time, but for the past many years, as we've also discussed, this has been a big driver of the market. So we look to kind of identify this because it just simply means that if volatility starts during that period, this won't be a source of buying that will step in and absorb that.
Moving on to interest rates. First chart is looking at real yields. And as we see here, real yields have spiked of late.
Well, brief correction. This is actually the 2-year yield relative to the Fed funds rate.
Oh,
So
yeah.
basically, this is what's saying is you could say it kind of like the real yield of the Fed funds rate versus the
Yeah.
real yield being this over inflation. But it's going to more or less kind of look to be the same. But for the first time in really a number of years, the 2-year yield is above the Fed funds rate, meaning that in order for the 2-year yield to stay where it is, the Fed is going to have to hike a couple times. And if the market were to then, shift and think that like maybe interest rate cuts are back on the table, you would then have a move in the principal appreciation of a 2-year bond that would be greater than what you would receive in yield. So this is a situation where for the first time in a couple years, again, people can buy a 2-year bond and say, hey, I'm going to receive this yield that's higher than the Fed funds rate, but the Fed cuts interest rates. I should make some money. And you could say that the 2-year is now mathematically at least a better diversifier to stocks, assuming stocks sell off because of an economic slowdown.
Yeah, and it tends to, again, in the past, it's slowed down investment outside of that because people are paid to hold short-term, U.S. Treasuries. Next chart looks at the cooling inflation expectations. We talked about how the PCE index has went up and spiked. It's well above where the Fed's target rate for inflation is, but expectations for where it's going have come down quite a bit.
So this is to what you said about the last chart, thinking about real yield. So the 10-year yield has gone up, inflation expectations have gone down. So if you look out 10 years in time, the real interest rates on 10-year bonds has gone up pretty substantially since a few months ago. That could potentially, as we've been talking about, start to draw some capital back into bonds, assuming that we don't really have an inflationary impulse to the economy.
Which, with the Iran situation calming down or working on a long-term truce and oil rolling over, again, that's part of the input to the inflation expectations coming down, is oil is no longer a positive contributor to it. Next chart looks at rolling 1-year total returns of stocks versus the 10-year U.S. Treasury, and we've been in a scenario where the stocks have returned substantially more recently.
And over time, it tends to have been the case where you would have kind of back and forth across, years and cycles where bonds would perform and stocks would outperform. But to your point, it's been a pretty big run of stock outperformance, which back to our prior discussions about real interest rates being higher, this could in fact be a scenario where if the economy does start to slow, bonds at now very high interest rates relative to the last 10 or even 20 years start to look really attractive and might could compete with some flows from stocks.
Yeah, and the counter to that is we have another 2020 2022, where if inflation stays high and the 10-year yield stays high, but maybe equities come down, you could have a scenario where both of them go down, and that's the uncertain waters we're in right now. Is the macroeconomic backdrop isn't similar to what we've seen necessarily for the last 30 or 40 years. Moved on to the next section, looking at non-US, aka the tour. First chart looks at the South Korean Kospi index, and we see some big moves here.
Back to the semiconductor theme. This is very much within the semiconductor ecosystem and in particular the memory space. So after what's been just an incredible move higher, you see here where the market had an enormous down day and kind of broke back below what were the recent highs. Just since we've started putting this chart together some days ago, it already looks like it's kind of headed back up and to the right. Again, there's been a lot of volatility after a big move. So we'll see if capital continues to really disproportionately favor that narrow space of the semiconductor ecosystem.
And moving on to Brazil, this is Brazil relative to the South Korean stock market. Brazil, more of a commodity exporter, if you will. And as you see here, they've dramatically underperformed Korea, while both being big components of the emerging market broader landscape.
Yeah, so anybody that's being benchmarked or allocating to MSCI emerging market as a category is going to have some percentage Brazil and then some percentage Korea, and then depending on how they would weight between the two. But yes, Brazil is a commodity exporter. Korea obviously imports commodities, and Brazil is really a play on high real interest rates versus Korea is what has become levered. I think AI semiconductor euphoria, at least in the near term. So we'll see how this plays out, but I think at least near term, one could say Brazil has some relative value, not just in general, but within the EM space.
Last chart on the tour is Chinese technology companies, which for a long time traded kind of in line with the United States NASDAQ. And, we've talked about how that relationship is broken. And just looking at Chinese tech in isolation, they've performed very poorly, really, for the last year or so.
Which is interesting. Back to the chart at the beginning showing that Chinese open source AI models are really starting to take market share versus the US models, even though those are connected to or put out by these big Chinese tech companies. It's just not showing up in the share price, which I think would have to just make everyone think that the mechanism of what moves the stock market there, is quite different. And it is communism.
It is. And, do you trust the accounting? That's a 20-year conversation. But just looking at the asset class, Chinese technology shares, they've gone nowhere but down for an extended period of time, despite some pretty positive backdrop catalysts. Last section, looking at commodities. The first chart looks at WTI crude oil, and we've about worked off all of the Iran war conflict, whatever you want to call it. All the increase, about all of it's gone.
Yeah, I mean, could never be enough said about how remarkable the situation has been with oil, and that ultimately, as we're seeing right now, price absorbed what everyone thought would have been the most just remarkable, damaging shock to the oil market. I mean, I've been writing books about that since the 80s or the 70s, maybe. And
didn't happen.
Didn't happen, and here we are.
The world rerouted its oil supply.
And I think it'll probably be obvious in hindsight that this is sort of when the world stress tested the fact that it needs less oil relative to other, sources. Just several anecdotes, but a lot of that electricity generation capacity in China that we showed in the prior chart, a lot of it comes from solar. They've obviously shifted a lot over it towards coal. And then if you look at another big market like Brazil, this is something interesting, is that so much of their electricity output domestically has gone to solar panels, and those solar panels aren't integrated to the grid so that whoever has those solar panels can sell it into the grid, that they're having a grid mismanagement during the World Cup because people are all sucking from it at the same time, or they're not, and they're just trying to contribute. So whatever country you look at, the infrastructure set up around electricity is pretty different, and it really is increasingly important because of the AI situation.
Next chart looks at some of the precious metals and their performance so far this year. If end of last year, coming into this year, everybody was talking about precious metals, precious metals, precious metals. We had silver with that massive spike, and here we are, halfway through the year, and most of them are negative after being some of them substantially positive on the year.
Yeah, it was interesting for the metals, in particular gold and silver, because they had kind of came into the year in a very euphoric moment in terms of price speculation in their own mini version of what we've seen recently with semiconductors and we've talked about. So then not only did that was the starting point, but then they got hit with shifting to the second chart here in the case of gold, a rising dollar, higher interest rates, and so on. And those tend to be headwinds to all metals, but especially precious metals.
Yeah, and where we go from here, who knows, right? There could be a scenario where they continue to flatline, go sideways to slightly lower, and there could be a scenario where they get a bid. We shall see, but where the dollar goes, where oil goes, where inflation goes, as we've talked about today, in almost every section, that's going to drive a lot of asset prices across the board. That was this chart overload. We appreciate you spending some time with us. We know you could spend a lot of different places for 30 minutes. We hope you learned something. If you have any questions, you want to talk about any topic in greater detail, please reach out to us at info@sollinda.com, info@sollinda.com. We'll be back in a couple weeks with our webinar. Hope everyone has a great week.